than it probably is today. So if we look at global investing in tech, it doesn't mean much. I mean, tech, and especially early stage, is a question of, being local. So, I think the one idea I would really want to stress today is like making sure that, you apply this, to your investments. There's a typical rule in the US, where they always say, I don't want to invest in a company which is, further away than 20 minutes from my office, right? And there's a lot of different reasons for that. 20 minutes in the US, and especially the Valley today, can probably mean 500 meters because it's all, jammed and stuff. But, the idea is that you want to relate to founders very early on. So, I'm pointing the US, and everyone is, because obviously the tech investment industry sort of started in the US. By a Frenchman, by the way. But they started this concept of how can we invest and create something new with capital. And capital can be, human capital and financial capital. And these are the sort of two major things you need to build, a tech ecosystem. So when you look at the US and how it sort of built up until the recent years, tech has been around forever. And, the one key element in the US, I was talking about human capital and financial capital, is the level of ambition these guys have over there, right? And, they obviously want to sort of conquer the world, and they do that in their politics, and they do that in the business as well. And so this level of ambition, where you can tell your people, hey, we're going to go to the moon and actually deliver, makes them incredible entrepreneurs. And on the back of that, they have some of the best universities in the world. So obviously there's no doubt why all this sort of tech ecosystem sort of was built around Stanford, Berkeley, UCLA, all that sort of California dream. So you had this shaker of ambition and talent, which is one key element to building a tech ecosystem. And then on the back of that, you need money. And that's where it's going to be interesting for the rest of our discussion, because money, especially very early stage, in every tech nation, and the US is one of them, obviously, started with public money. It started with government. So a lot of people forget about that today. They're all about raising funds and this and that. But the origin of how the US ecosystem was built is because government paid millions to entrepreneurs, to tech people, to sort of win the war against Russia. That was the idea, right? So these people attracted talent. At the beginning, a few Germans and stuff, put a lot of money into it, and ultimately built that ecosystem of being able to attract talent, put money, and build crazy stuff that could be funded forever. The government could have been, funding these companies forever. Israel is also a very interesting case. The reason why the tech, ecosystem in Israel is so big is because they have the exact same situation. They tried to win a war, and I'm not going to get into any politics here, but they tried to protect themselves and win a war against the Arab world around them, right? So they invest tons of money into army and the army, and therefore, when you look at Israeli entrepreneurs, the vast majority of them, they're all, 80 to 100, so the sort of key army school in Israel, and you put this plus money in, because the government put a lot of money into financing the first stages of the ecosystem, and then you get a very fruitful startup scene. What about the rest of the world? What about China and Europe? What happened there? So if you look at the model, China was lagging behind. So once again, if you do a bit of a macroeconomic study of how it worked, for the last 20 years, because they went into their industrial revolution, they attracted a lot of money, selling to the rest of the world, and then they wanted to build some tech scene, because they thought obviously that it's the future. We've been very good at industrial. How can we do IT and tech in the future? And in a very in a very typical Chinese way, they sort of close the borders and say, well, look, we're going to focus on our own market, and make sure that the Google and the Facebook of this world never get in. So we're going to make sure we're going to create our own champions. Fairly easy. You close the door, put money in, get a few Chinese people who, for the very few of them, got to study abroad, US or Europe, got that sort of entrepreneurial feeling, come back in, put money because they have loads of money, bang. You create these massive champions. Huge, because you have a massive market, obviously. 1.2 billion people, a lot of money, and it's done. And so the Chinese ecosystem sort of went from zero to what it is today, creating more unicorns than the US, just because of that. Then when you look at Europe, very interesting case. So Europe, we don't have the scale of the US, we're not as big, don't have the scale of China, same story. We have been, massive promoters of openness for the economy, and we've always, due to our, and it's an unfortunate or fortunate day today, the end of the war, but due to this, we've always pushed for, open frontiers and making sure that we could partner with others. So we didn't take the Chinese route, so we didn't decide to sort of close the borders and build our own champions. We said, well, we're going to live with an open world, so we're going to make sure that, everyone can make business in Europe and we're going to be open for it. So therefore, the first wave of tech, there's two, if I take the American example, there's two major things here. We had talent, for sure. I mean, some of the best universities are in Europe. If you look at Oxford and Cambridge, and then Paris, Sorbonne, and all of this. So there's no doubt about talent, for sure. But there was no initial capital in the early days. So why is that? Because we were post-war and we weren't fighting against the Russians. I mean, it was an American problem rather than a European problem. We were sort of rebuilding the country, and we didn't really have to think about that. So that sort of came in much later. And to be honest with you, when you look at the numbers, and it's very interesting, the biggest tech nations in the world. So if you take the US or Israel, they spend 0.5% of their GDP in tech. So the investment in tech, generally 0.5% of your GDP is what you do. So that's true in the US, true in Israel. And if I take a European example, in 2012, in France, the whole tech economy invested 0.05%. So there's an order of magnitude which is 10 times less. So you have a country where you have a pool of talent, you have an okay market. It's not huge, but it's 60 million people, well developed. There's plenty of things to do, but the whole thing wasn't working properly. So what launched the market is the development of the new tech, and mobile was one of them. There was two sort of front and back end innovations that sort of push the wave we know today. Mobile is one, so being able to have data everywhere all the time in your pocket, so very close, and it's an amazing customer engagement tool, and that's what made it possible. And on the other end, cloud, on the infrastructure end, because obviously all of a sudden you didn't have to start a business and invest millions into servers to sort of start coding and having a website. So when the governments in Europe sort of realized what was going on, they said, hey, we need to push that, right? We need to push and make sure that there's enough money flowing in so that the tech economy can be thriving. And that's what they did. So, every European country, and even the European Investment Bank, actually invest in tech. The average is probably 30% of every fund is kind of covered by public money. And the earlier stage, the more money they put, whether it's grant, whether it's facilities, whether they pay for entrepreneurs to start, whether they finance incubators. So that's the kind of wave you need. It's been fairly successful. So when you look, at the numbers and the growth that Europe experienced over the last years, look, it's fantastic. Like, it's literally, booming over there. I mean, you look at the different companies and, the few unicorns that got created and the Spotify and all this world, and you realize that, the trend is getting there. So now what about Africa? How can you approach this with, the constraints and the advantages and disadvantages of the continent. Well, first of all, I'm not going to teach you much. Africa is huge, right? And there's 54 countries, and the example of Malawi versus South Africa, it's very different. So it's very hard to talk about one continent as a whole, but more, as I said, and as I started, a combination of local ecosystems. And I gave a big trend about Europe, but the French case is different from the Spanish case, which is different from the German case, but you have bigger trends. So what could be the big trends here in Africa to sort of push the tech scene? First of all, there's human capital. So how do you make sure that you have the talent you need here? And talent is a very open word, so like it can be, the definition is pretty broad, but making sure that you get exposure to other markets, to other ways of thinking, to other business models, making sure that you create this wave of repats, as we say in Europe. So people who were abroad, either in the US or Europe, come back, bring these ideas, and to have these people coming back and bring the, sort of a different mindset to it, you need a trick. You need to give them an incentive to come over. So that's where the second part kicks in, which is the government part of it. And governments in Europe facilitated repats in terms of visa, tax purposes, and the same for investment. So making sure that investment in a certain area, if you want to develop it in the future, has some advantages to it. So you got tax cut, advantages when you exit, so no capital gains, a lot of stuff to facilitate this. And then above everything, the simplicity. And we spent the weekend with a few other investors in Africa and talking about what works, what doesn't work. I think one key thing is simplicity. I mean, for every one of you who have already started a company or invested in a tech company, you know that there's a million things that could happen and turn wrong and make the company die. Right? That's it can be the market, your product, your providers, your clients. I mean, name it. A million things. If on top of that you add a complexity around the way you structure your company, the way you finance it, it's terrible. Like you're literally digging a hole and making things much complicated. So I think if there was one thing we should push, African governments to do to facilitate the tech ecosystem growth, it's definitely around regulation, making sure that IP is well protected, making sure that everything around tax and investors' treatment is fairly transparent. So investors don't think about that. They can take the tech risk, they can take on the African risk, they can take a lot of stuff, but they don't think about the rest. Like it's an extra risk that people don't want to mess about. And I think going back to what happens in the world, China is a good example. I mean everyone knows and has always known that investing in China is complicated. So they set up that model where you have a WOFE, a foreign-owned company in Hong Kong, and then with a subsidiary in China, and every international investor in the world knows how to invest there. It's a fairly simple model. You go into Hong Kong, zero tax, transparent, free, and then subsidiary in China, and you can have your business there. So that's the sort of models where facilitating this for international investors makes sense. Because to finish with the capital, financial capital in Africa, there is appetite. Look, if you look at the numbers between 2017, 2018, I mean, the market went up from a couple of hundreds to 1 billion invested in Africa. So yes, it's not a lot, because when you split down, it's like 300 mil in the 3 major regions and then a few left for the rest. But look, that's where Spain was a few years ago. I mean, France was 1 billion when we started Breega 5 years ago, right? But when you look at that, I mean, when you're at 300 million today, with the population growing and a lot of potential, you can definitely get there. So I think it's not a matter of not, well, it's hard to find capital, but there is appetite. I think, you know, a lot of people believe in the sort of grand vision that, you know, Africa, A, is one of the few continents growing in terms of population, B, where a lot of things need to be built and done. So the conviction, you know, you guys should have is that, you know, yes, there is capital available. It is complicated to flush back to Africa. One of the reasons for that is the complexity around government and rules, and therefore, as an ecosystem, I think, you know, we should push governments and regulators to change the environment. So that's one key thing. And then on the talent side of things, I think, you know, that's one of the reasons why these events are made for, just, you know, share as much as you can. And, you know, the vast majority of the tech scenes and tech entrepreneurs are very open for exchanges and coffee and ideas. So I think there's a lot of potential there, and try to look at what the different regions went through and build up your own model, because obviously the things that happen, you know, or worked in China or the US never quite happen where you want them to do. So let's build an African, you know, way of building tech.
Thank you very much for that, Ben. Before we go to the next panel, which will probably start in the next couple of minutes, next 3, 4, are there any questions? You're obviously very brilliant, right? You've answered everything for everybody. So, ladies and gentlemen, once again, Ben Marrel from Breega Capital.
Thank you, thank you.
Now, Ben will be coming back up. We've got that panel that I was talking about. I just want to make sure that everybody is mic'd. Yes, they